Welcome back to another edition of the Retirement Roadmap video series brought to you by SHP Financial. I'm your host Keith Ellis, and we have some important topics to discuss here today. Today we're going to talk about the future of healthcare. A big expense for a lot of folks out there as they move into their retirement years, some of the holes that can be found in your current plan, and we want to get those addressed and also project out into the future what that's going to look like as you retire and come on to a fixed income. At SHP Financial, we have a retirement roadmap process where we believe that 5 plans make up one holistic retirement plan. First of all, you need an income plan. Once you have your income established in retirement, then we start to build you an investment strategy. We want to make sure it's tax efficient. We want to make sure that you're leaving money the correct way to your beneficiaries. And then finally, what we're here to talk about today is we want to make sure your healthcare needs are addressed. So let's jump into it. Many of you know, and we talk about time in and time out, the national debt. It's a number that you hear, $18 trillion plus. There's a great website, usdebtclock.org, that we follow and look at and see our national debt. But that number's thrown at you time in and time out if you're looking at any political, watching any political TV shows, reading any political publications. They're talking about the national debt. But what you really need to look at is a much bigger number. The debt associated with Medicare, over $27 trillion. And what does that mean to you, or what does that mean to folks getting ready to retire? It means the cost of your insurance premiums are going to start to go up. And I would expect that to go up. Why is that an issue? Because when you retire, you're typically on a fixed income, or you're budgeting for a fixed income. One of the biggest mistakes that we see is the lack of inflation planning in people's income. People aren't taking into account the cost of living. But then you add in the exorbitant inflation factor associated with healthcare. That is an astounding number that you have to plan for. So we at SHP Financial focus on these numbers. One of the biggest holes in your plan, most likely today, is long-term care. Now, no one likes to talk about long-term care, but let's be adults about this and realize that it is an issue, that it is something that needs to be considered, and it is a hole that can leave your spouse or your family a lot less than you think you're going to be leaving them today, right? Numbers associated with the state of Massachusetts. So most people, when they think about long-term care, they want to go and they want to be at their home. They want to stay at home, right? I pulled some numbers. To stay at home for a long-term care stay, you're looking at about $55,000 a year. Now, that's 1 year. The typical long-term care stay is 3 years. So now we're upwards of $150,000 plus for your typical long-term care stay. That is in today's dollars. So if you're 60, 65, 70 years old, you might not need long-term care for 10, 15, 20 years. And the cost of healthcare, the inflation rate associated with the cost of healthcare is huge. So what is $150,000 today could be $400,000 or $500,000 down the road. Now let's take a look at a nursing home. No one wants to go to a nursing home, but guess what? It's sometimes inevitable. Sometimes that's the only place that you can go, right? Today's costs are about $140,000 a year to go to a nursing home. Again, the typical stay is about 3 years, or the typical long-term care situation is about 3 years. You might spend some time at home, you might spend some time in a nursing home, but let's say you ended up all 3 years in a nursing home. Now we're looking at, $450,000 for long-term care. And that's in today's dollars. Again, what if you're 65, 70 years old? You might not need long-term care for 10, 15 years. That expense could be $700,000 to $800,000 at that time once inflation starts to get a hold of this. So these are huge numbers, and again, these are holes that we see in people's plans that need to be addressed. So, how do you address them? Well, you have 4 options. First option is to self-insure. What self-insure means is you're going to use your own assets to pay for long-term care. That's an expensive situation. That's a lot of times folks that come in and see us, that's not the route that they're trying to go down. The second is traditional long-term care insurance. Equate it to like car insurance. You pay a premium every single month. You might use the policy, you might not. At the end of the time period, the insurance company keeps the premiums if you don't. But if you need it, for what you're paying in cost to what you get in benefits is a lot. So in relation to that situation, you can buy a lot of long-term care insurance for a little premium. Okay? Some of the downsides associated with traditional long-term care insurance. 1, the insurance company always has the right to raise your rate in the future, and they will, because the cost of healthcare, remember we just talked about inflation and the cost of healthcare, that is happening. So they need to protect themselves. What they will ask you to do is either pay more in premiums on an annual basis to keep your benefits the same, or reduce your benefits to keep your premium the same. Therefore, at some point, making your policy obsolete. So, another downside of traditional long-term care is, is what if you never use it? You're paying these premiums and you might never use it. So a lot of people that we meet with have some type of long-term care insurance. Do they like it? Do they not? That's a personal preference, but they are looking for ways to address this issue. The second way to address the issue is with an annuity that has a long-term care rider. So what that means is annuities are contracts with insurance companies that will pay you a specific amount of money on a monthly basis or on an annual basis, typically for the rest of your life, depending on how it's structured. Now, say for instance you have an annuity that's paying you X number of dollars on a monthly basis. Let's call it $30,000, and you have an annuity with a long-term care rider. That $30,000 will then double to $60,000 a year for a specified period of time, typically about 5 years. Now the benefits aren't significant. $60,000 compared to the numbers I just gave you aren't huge when it comes to a nursing home. So where are we seeing these used? Folks typically want to stay at home. That's when the annuity with the long-term care rider usually comes into play. The final way that folks address long-term care, and what we see is increasing, is the use of life insurance. Yes, life insurance. Most people think of life insurance as mortgage replacement policy. A husband or a wife dies, they have a $300,000 mortgage, they might have a $300,000 life insurance policy to cover that mortgage in case one of them were to pass away. But life insurance is a unique vehicle that allows us to leverage a death benefit to be used as well for long-term care. Why is this an important aspect of planning for long-term care? Well, if a life insurance policy is set up correctly, the premiums are actually locked in. So as you go into your retirement years and you're on that fixed income, you can plan and know what your premium payments are going to be year in and year out for the rest of your life. 2, it can provide significant benefits for long-term care. Just like the first way that I told you to cover long-term care insurance, the traditional long-term care way, life insurance can have that same type of leverage. Finally, it eliminates the question, what if I never use it? Because somebody is getting paid. If you need long-term care insurance, you're getting paid a specific amount of money on a monthly basis or on an annual basis to cover a portion or all of your long-term care insurance needs. But if you don't need long-term care, there's a nice tax-free death benefit that is passed on to the next generation. When people come in and sit down with us, these are the issues that we're addressing. These are the things that we're looking at as part of our process. Again, it's our belief that you need 5 plans: income plan, investment plan, tax plan, healthcare plan, and legacy plan. They need to tie together to create a holistic retirement plan to get you to and through your retirement years. Thank you for your time today, and I hope you find this video informative.